recent weeks, initial hopes that the pandemic shock would be followed by a quick V-shaped recovery has given way to the realization that recovery will likely be a more drawn-out affair, even if operating under the assumption that a second wave of infections, which would bring about a W-shaped recovery scenario, can be averted successfully in the fall and winter. This is reflected in the recent downward revisions to the International Monetary Fund's growth outlook, where global growth for 2020 has been revised down by another 2% to a decline of 5% of global GDP. Nonetheless, this is expected to be followed by a rather quick recovery that should see us regain all of those losses by the end of 2021. However, that is not the case for advanced economies. There, not only is the initial decline at 8% expected to be significantly steeper, recovery as well will take longer, with pre-pandemic levels of 2019 GDP only expected to be regained by sometime in 2022. Indeed, equity markets globally seem to have decoupled from economic fundamentals, despite corporate earnings being expected to drop by about 30% on average. This strong market recovery has propelled valuations to levels that we have last seen in the days of the internet bubble at the turn of the century. This comparison is strengthened by the fact that it is again the technology sector leading to the upside, with tech stocks being seen as impervious to the economic down. To justify valuations for US equity markets, one has to look through the ongoing recession and further assume that the losses in corporate earnings are going to be fully regained by next year already, an assumption that seems unpersuasive given current economic trends. Furthermore, equity market behavior stands in stark contrast to other asset classes, such as sovereign fixed income, where yields at the long end remain near record low levels, suggesting an extended stretch of anemic growth ahead. The primary driver of this equity market decoupling is to be found in the enormous amounts of liquidity that central banks have unleashed on financial markets, and that go way beyond anything that we have witnessed in the global financial crisis 10 years ago. Most notable and truly unprecedented are the steps that the US Federal Reserve has taken in terms of supporting even corporate credit markets, going as far as buying certain junk-rated company debt even, and that clearly has eliminated certain tail risk for the corporate sector. It is, however, important to keep in mind for investors that in the end, central banks can only provide liquidity support. Once solvency comes into question, the supportive measures of central banks lose their power. For investors, it is important to realize that not all equity markets are equally overvalued. Clearly, from a valuation point of view, US equities should be left alone. This is a market where another lost decade looms, similar to the aftermath of the internet bubble. On the other hand, looking at emerging markets and certain European equity markets and even Japan, the expected returns over the medium to long term are quite attractive. From a factor perspective, it's notable that value stocks have extended and even accelerated their underperformance versus growth stocks into this downturn. In fact, this is a trend that has been with us for the past 10 years already, and the historical record suggests that we are likely to see mean reversion kick in sometime soon. However, for value stocks to sustain outperformance versus growth equities, we will require an improving economic backdrop. For any further questions that you may have, please do not hesitate to get in touch with your client advisor.